Hello, good morning. This is our introduction to valuation lecture for advanced corporate finance. We define what is valuation. So valuation is the estimation of an asset's value based either on variables perceived to be related to future investment returns or on comparison with similar assets. So when we talk about valuation, we are talking about the process of determining the value of an investment opportunity. Okay. And the determination of value can be based either on variables perceived to be related to the future investment value or in comparison with similar assets. Okay. And those two methods of valuation are called absolute valuation and relative valuation. Okay, so yung absolute valuation, that is valuation of an asset based on the specific attributes of that asset or investment. So if you're, for example, buying stocks of ABS-CBN, absolute valuation considers the attributes of ABS-CBN as a company. No? What's their balance sheet? What's their growth prospects, etc. And we use those attributes, no, to determine what's the value, what is the correct value of ABS-CBN stocks. Okay. On the other hand, relative valuation means you are trying to determine the value of an asset with respect or compared to similar assets. Okay. So those similar assets for ABS-CBN, for example, a similar asset for ABS-CBN stock is GMA7 stock. Okay. So can we value ABS-CBN with respect to GMA7 stocks? Probably because they may be similar assets, right? And later we will discuss that under the law of one price in economics, similar assets should be priced similarly. No? And when we use the value of others to value the asset that we are looking into, that valuation approach is called the relative valuation approach. Okay. Here in this in valuation, what's a very important concept is intrinsic value. Okay? The intrinsic value of an asset is based on the investor's perception of value based on his or her own estimation. Okay? So, parang if you look at it, intrinsic valuation is an investor's study, okay, of what is the true value of this of a certain asset. Okay. However, true value actually depends on who the investor is. Okay. Because an investor might have different perceptions of value, right? No, so for example, we're trying to value land in Quezon, for example. Okay. Kung ako, may kamag-anak ako sa Quezon, probably my estimation of value for that piece of land is higher than someone na taga Surigao, right? Why is that the case? Because yung taga Surigao, mababa ang valuation niya nung lupa sa Quezon kasi hindi naman yan na-appreciate kung para saan yung lupa doon. Okay? Pero ako, taga Quezon ako, for example, na-appreciate ko kung ano yung potential ng lupa sa Quezon. And therefore, my intrinsic valuation might be different from someone from Mindanao who is unfamiliar with the value of land in Quezon. Right? So our perception of value is different, and therefore, the second point is very important to us. There is no right valuation. It depends on what you can do with the asset. Okay? Kung patitiwang-wangin mo lang yung lupa, syempre that value will be low. But if you have plans on the land, if you have plans to develop it, then you have a higher perceived value, and therefore you have a higher intrinsic value of that land. Same is true with stocks or corporate acquisitions. Okay? How you perceive the value of that business is dependent on the potential that you see, right? An investor who sees more potential in a company X No, versus another investor who may not be knowledgeable on the industry of company X. So hindi niya ma-appreciate what are the nuances of the industry of company X, will have a lower intrinsic valuation. Okay? So, yun ang, that's the difficulty, I guess, with intrinsic valuation. It's based on attributes, and the attributes, it depends also on your um, understanding, of what returns that asset can provide. Okay. Um, Next, it is unobservable. Intrinsic value is usually unobservable, no? And therefore you need analysis, and that those analysis require estimates. And of course, if there are estimates, no, then there is some form of error in the analysis. Okay, so the fact that it's unobservable means there's no consensus. No, there is no one single valuation for any asset. No? So the entire process of valuation should be structured as a triangulation from several vantage points. In other words, there are many ways, no, on valuing, or many ways to value assets. And usually what happens in valuation analysis is we use all of them or most of them, no? And upon use, we triangulate them or compare the results and use the three numbers, no, as our basis for the acquisition price of a merger and acquisition. Okay. So that's something that we will discuss later on. So therefore, also in intrinsic value, we do not work with point estimates. We work with ranges. And those ranges are based on sensitivity analysis or the use of multiple valuation approaches. So the whole aim of valuation is to find and exploit profit-making opportunities. Okay. Remember, in mergers and acquisitions, price is different from intrinsic value. Okay. And price will never be equal intrinsic value. Why? Intrinsic value is the value of the business that you're acquiring. If you're buying it at the same price, edi wala kang nakuhang extra value. No, for example, you're buying San Miguel Corporation. Okay? Ang intrinsic value ng San Miguel, 10 billion pesos. So, sa business mo, may dagdag siyang 10 billion pesos in terms of value. But if you paid also 10 billion pesos for it, minus 10 billion, edi zero ang net impact sa'yo. Because you paid 10, you received 10. Right? So, the intrinsic value is 10, the acquisition price is also 10, and therefore, there is no value. Okay? So, there is value if the price is different from the intrinsic value, price of the acquisition. So, what are the rules in creating value and avoiding value destruction? From the buyer's point of view, he will only accept an M&A deal, no, if the intrinsic value is greater than the payment. Okay? So, payment meaning acquisition price. Kung 10 billion ang intrinsic value, kung 5 billion ang acquisition price, then there is value to create, and therefore, an acquisition is worth pursuing. The seller's point of view naman is different. Payment is greater than, should be greater than the intrinsic value of the target to the seller. Okay? So, if that's the case, how can they agree? You know, how can they agree? Di ba sa buyer's point of view, dapat intrinsic value greater than the acquisition price. Seller's point of view, acquisition price should be greater than the intrinsic value, of the target. Then how can there be M&A deals? How can they agree? No. The difference is they have different perceptions of value. They have different intrinsic values. Okay? Remember, during a due diligence or during a merger and acquisition, there's information asymmetry. Okay? Uh, Hindi alam ng buyer yung lahat ng problema ng seller. So the buyer has a view on the growth aspects, has a view on the downsides. The seller, on the other hand, has his own set of information. Alam niya yung potential growth, alam niya yung potential uh, downsides, no? Pero nakakahon din siya kung ano yung perspective niya when it comes to the growth of the business. A buyer, on the other hand, might have new ideas on how to grow the business and therefore might have a higher intrinsic value. Okay. So from the point of view of the buyer, an acquisition will only happen if he can find synergies, if he can find growth opportunities that will make his intrinsic value higher than the seller. No? And if his intrinsic value, if the buyer's intrinsic value is higher than that of the sellers, then there is a deal to be made. No? Because masasatisfy mo tong dalawang rules na ito. Okay? But if the buyer's intrinsic value is lower than that of the seller, a deal will never be made, right? Unless one of the two parties is willing to destroy value, okay? Which usually they will not be amenable to. Okay. Now, there are two types of values, when we talk about mergers and acquisitions. Number one is the enterprise value. Number two is the equity value. Okay. So the enterprise value is the value of the whole firm, the intrinsic value of the firm's assets. Okay. So kung ang ina-acquire ng isang investor are the assets of a company, that valuation is enterprise valuation. Okay. On the other hand, equity valuation, no, is the value of equity. And therefore, kung ang binibili mo lang is common shares, no, or the shares of a company, the valuation that you will need is equity valuation. Okay. The two are related because enterprise value is equal to the value of debt, no, plus the value of equity. Okay, so they are related. Okay, enterprise value is higher than equity value kasi enterprise value is value of debt plus value of equity, which in essence is the value of all assets of the company. Okay, because in mergers and acquisitions, you can buy the assets of a company or the shares of a company. So kung assets ang binibili mo, then enterprise valuation ang kailangan mong gawin. If equity naman or shares of stock ang binibili mo, then you need to determine the equity value. Now, what are the different approaches to firm valuation? Maraming ways to get the value of an asset or equity. Okay? Some of them are sophisticated, some of them are not. No, they're not sophisticated, but they provide um, certain insights. No, so I'll go through them one by one. Now, one basis of valuation is the book value, no, of the assets or of the equity of the company. Okay. So basically, it's based on the audited financial statements, no, of a company. So titingnan mo yung FS, ano ang total assets doon, no? Accounting total assets, no? And the total assets there will be the book value of assets, and therefore it can be regarded as equal to the enterprise value. Okay? If you want equity value, tingnan mo yung total stockholders equity sa libro, no? And the total stockholders equity will be the book value of equity, and that could be an estimate for the valuation of equity, right? Um, if that value of equity, what is the relevance of that? The relevance of that is yun kasi yung ininvest amount, actual amount, no, na ininvest ng shareholders. Okay? The book value, fine, it's an accounting number, so it's not very, I mean, it's based on accounting rules. No? But if you look at the total stockholders equity of a company, more or less, yun ang amount na ininvest ng owners of the company. Right? So therefore, if you look at it, most sellers, no, in a mergers and acquisition will 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 not price below book value. Okay, yun ang relevance ng book value eh. No, because if I invested 100 million pesos in this company in equity, that's the minimum that I want to get. No, unless of course it's very obvious in the business that palugi na, no, fire sale na, and therefore you, most likely the seller will accept a pricing below book value. But if it's a growing company with good potential, more or less, that company or the seller will not sell his shares in this company lower than book value kasi yung book value, yun yung amount na invest niya. Okay? The problem with book value is it actually ignores certain assets that are not booked. No? So for example, brand names, wala naman yan sa books. Patents sometimes are not in the books or understated in the books. Technical know-how, managerial competence, those are assets, quote unquote, of the company, but they are not part, no, of what's in the financial statements. So it's being ignored. No, that's the problem with book value. Um, the method ignores a price appreciation due, for instance, to inflation. Okay, kasi historical cost ang nasa financial statements. So if those assets increased in value, hindi yon covered in book value. And these estimates may be appropriate for firms with no intangible assets only, or most of its assets are at valued at market value. Okay. So why is this important? This is important because it gives one data point of potential pricing, right? So kung ako sa'yo, titingnan ko pa rin yung book value. Bakit? Kasi yung book value, malamang yaan yung minimum ng isang seller. And as a buyer, you should be aware of what that price is. No? Kasi if you want to price lower than book, then matinding negotiations yan with the seller. Okay? And you have to justify with the seller. No? Sabihin mo talaga sa kanya masama yung business niya or pangit yung prospects ng business niya. That's why I am only willing to buy it below book value. Okay? An alternative to book value is liquidation value. Okay? This is even more conservative, no? Because it simply sums the values that might be realized in a liquidation of the firm today. And if the company is liquidated meaning isasara, okay? At kung isasara ang isang company, what do you do with the assets? No? You have to sell the assets individually in an auction, okay? So bawat assets i-determine, cash, magkano ang matatanggap natin, receivables, magkano pa ang matatanggap natin. Inventory, benta na natin yan ng fire sale, magkano matatanggap natin? PPE or fixed assets, pag binenta ba natin yan ngayon, magkano matatanggap nating value? Okay? So, liquidation value intends on selling each individual asset. No? At kung nakuha mo yung selling price ng each individual assets, then yun yung enterprise value. Ang equity value naman, ibibenta mo yung individual assets, so makukuha mo yung total value of the assets minus liabilities, then makukuha mo yung liquidation value of equity. Okay? So, it's more conservative because, it's more conservative because usually the market values of used assets mababa, right? And therefore, nadi-discount palalo yung book value. Okay? So, an example is in the next slide, no? For example, in Exhibit 8.3, no? So if this is the book values, no? In the appraisal process, ang ginagawa dyan is that dinidetermine how much, ilang percent ng book value ang makokolekta pa in terms of cash pag binenta in an auction. Okay? And that percentage is multiplied to book value and nakukuha yung liquidation value. Okay. So in this case, receivables, for example, is 30. Let's assume this is in millions, $30 million. The assessment of the appraiser is that it is 80% collectible, and therefore the liquidation value is 80% of 30. Okay. Inventories, plant equipment. In this case, the book value of assets is 100, no, but its liquidation value is only 63. Okay. And therefore, in this case, the enterprise value is 63. Okay. How do we determine the equity value? Okay? 63 is the enterprise value, i-minus mo doon yung debt that has to be paid, which definitely you have to pay everything, right? Then the equity value is 13 million dollars. Okay, if you use liquidation value. If you use book value, the equity valuation is $50 million. Okay. The problem with liquidation values is it tends to be appraiser specific, and they usually only does rule of thumbs. Okay, rule of thumb, and it's dependent on their appreciation of the physical assets. Another method is replacement cost valuation. Replacement cost simply means ito yung mga assets ng company, okay? Magkano ang gagastusin if I need to replace them? Okay? So for example, you are trying to get the replacement cost of a stock of Jollibee assets. Ang Jollibee assets is, for example, a commissary. That's part of Jollibee's assets. Okay? The value of that commissary, if you're using replacement cost valuation, is you will determine how much does it take to build a new commissary with these specifications. No? Then, then that value that you get is called the replacement cost of the commissary, and that can be a reference point in the valuation of the commissary. Okay, no. So it gives valuable insights on any high inflation setting. Okay, remember kasi ang book value hindi inflated. So um, therefore, replacement cost is useful if under your sa paniniwala mo may mga assets doon na nag-increase ang value due to inflation but is not recognized in the books. Okay? But this is rarely used, no, uh, because uh, because the usefulness depends if it's a high inflation environment or high inflation setting, which usually is not the case naman. Okay? But again, this is just one guidepost or one type, no, of one type of uh, valuation method. Current trading value. Okay? The current trading value is if the stocks, for example, is trading in the stock exchange, no, then merong observable valuation, no, for these assets. Okay? So, for example, again, let's go to ABS-CBN kanina. So the current trading value of ABS-CBN, if you're looking at the enterprise value, is simply the value of debt versus plus the value of equity. The value of equity is simply the share price times the number of shares. Diba? It's there. No, share, in the PSE, nandyan ang presyo. So makukuha mo yung total value of equity. Total value of debt naman, no, is literally by estimating the present value of debt cash flows, or usually kung ano yung book value, yun din ang equity value ng debt. Kasi wala namang variability usually ang debt valuation. Okay? So, you can use that as basis also of valuation kung may observable namang value sa market. Now, the current market value is extremely important as a reference point. No? Because we can reasonably assume that market prices reflect what is known about a firm. Okay? Ano ibig sabihin nun? Um, Companies which are traded in a stock exchange disclose information to the market. No? And when they disclose information, the market reacts by buying or selling the shares. Okay? And therefore, kung ano yung makikita mong price sa stock exchange, yaan usually yung price na consensus ng mga investors. Okay? Right? Parang they settled in that equilibrium. So that's the consensus price as of this point in time. Okay? And that consensus is based on publicly available information or disclosed information of publicly traded companies. And so therefore, The market price, the current market price, is a good indication of the price of the stock, okay, based on public information. And therefore, kung ako rin naman si seller, ay that would be my minimum price, right? If it is a traded company. Okay? No? Unless there are really bad items na nakita mo during the review process or due diligence process. Okay? So it's again, it's another important pricing post, no, or pricing reference kung traded naman sa stock exchange. No? Well, some companies are not, so hindi present itong current trading value in your valuation options. Okay? The most critical, no, or the most usual that's being used is discounted cash flows. Okay, so this approach, the theory behind this approach is that the value of a certain asset is equal to the present value of the benefits that you will receive from this asset. Okay, and what are the benefits that you will receive? That benefit is represented by the cash flows that you will receive from this asset. Okay, so in general, the DCF value is equal to the present value, no, of the cash flows of the asset. So if you look at this formula, no, so this is the present value of all the cash flows from year 1 to year infinity, kung hanggang kailan man yan, okay, divided by 1 plus K. K is the discount rate, no, raised to time. Okay? Basically, pinipresent value mo lang kung ano-ano yung cash flows na matatanggap mo for every year. Okay? So, while most firms have infinite lives, okay, actually, valuing such a stream would be impossible, right? Paano mo naman may estimate yung cash flows ng isang company from now up to forever, right? It's very difficult to do that. Usually, ang may estimate mo lang yung next few years kasi yun yung mas may visibility ka kung anong mangyayari. Pero malay mo naman kung anong mangyayari 20 years from now, 30 years from now, 50 years from now. Okay? So, how do we usually do this? Okay? So, usually, cash flows are forecasted to a reasonable horizon, no? Say 5 years. Okay? And then you add a terminal value. Okay? So, the terminal value represents our estimate of the value of the assets from year 5 onwards. Okay? We'll discuss more about terminal value in our example later. Okay? But in essence, under discounted cash flows, you will be forecasting the cash flows and discount them at the appropriate discount rate. Okay? If you are trying to get the enterprise value or the asset value, okay, the method of doing this is by computing what's called free cash flows to firm. Okay? And the enterprise value is determined by determining the free cash flows to firm and discounting it at the weighted average cost of capital. Okay? How do you compute the free cash flows to firm? Ito, no? Free cash flows to firm is equal to net income plus depreciation minus change in net working capital. No? In other words, itong first three terms na yan, that's operating cash flows. Okay? Plus interest times 1 minus tax, which is interest expense after taxes. Okay? Minus capex. Okay? Or capital expenditures. That's how you compute the free cash flows to firm. Why is the free cash flows to firm computed that way? Okay? Uh, ito yung cash flow ng business. Okay? Ito yung cash flow ng business bago bayaran ang debt and equity. Okay? Kung ma-imagine mo, 'di ba, ang statement of cash flows, 'di ba? May cash flow from operations, may cash flow from investing, at saka may cash flow from financing. Okay? Those three cash flows compose the total cash flows of a business in a certain year. Okay? Free cash flows to firm only determines or only includes cash flows before any payments to creditors or any payments of dividends. So parang nagsa-stop yung computation doon. Okay? Kaya ina-add back natin yung interest dito kasi interest is payment to creditors, right? In our theory behind the free cash flows to firm is that free cash flows to firm are the cash flows generated by assets. No? And therefore, dapat hindi kasama doon any cash flows related to debt and any cash flows related to equity. Okay? And interest, which is part of net income, diba, is part of payments to creditors. So, kailangan natin siyang i-add back para tanggalin niyo yung effects sa net income. Okay? So, that's the theory behind it. And of course, the weighted average cost of capital is something that you already learned in 280.2, no? Which, so cost of debt after tax times the proportion of debt in the capital structure plus cost of equity times the proportion of equity in the capital structure. Okay? So that's the K. That's the discount rate that we are determining. Okay? No? That's the discount rate that we are determining. Now, another portion is the terminal value. Okay? How do we determine the terminal value? Okay? We have to forecast also the terminal value. How do we do that? We get the free cash flow for firm at time T. What is time T? Yung last year na meron tayong forecast. Okay? Times 1 plus G over WACC minus G. G here refers to what? It refers to the terminal growth rate. Okay? The terminal growth rate is usually the steady state growth of a business. Okay? And it depends on the business attributes. Okay? So for example, if it is a food company, probably the terminal growth rate is equal to the long-term GDP growth rate. Okay? If it's a company wherein the capacity is fixed, meaning hindi pwedeng mag-expand, then the terminal growth rate might be equal to inflation kasi prices na lang ang magpapataas ng value niya. Hindi na magpapataas ng value ang real growth. Okay? So um, that could be uh, a basis for terminal growth. So, when you do this, when you compute this, no, nakuha mo na yung mga cash flows, nakuha mo na si terminal value, nakuha mo si WACC, okay? You're able to get, when you get the present value, you're able to get the asset value, no? Asset value or what's called the enterprise valuation. Okay? On the other hand, equity value naman, it's the same principle, iba lang ang numerator definition because what we're now doing is to get the free cash flows to equity and we discount it at the cost of equity. Kanina, we get the free cash flows to firm and discount it at WACC. Ngayon, we get the free cash flows to equity and discount at the cost of equity. Now, anong pinagkaiba? Kung mapapansin mo, okay, the formula is net income plus depreciation minus net working capital. In other words, that's cash flow from operations, right? Minus capex plus new loans minus principal payments. So in other words, kasama na lahat ng debt cash flows or cash flows related to creditors. Okay, kung napansin mo rin, hindi ko na in-add back yung interest expense post-tax. Why? Because it's already part of net income at dapat lang naman siyang i-deduct kasi we are now considering cash flows to cash flows to or from creditors. Okay? So ano lang naiwan sa normal cash flow statement that you are looking at, no? Ang naiwan na lang is dividends or transactions with shareholders. Yun na lang ang naka-exclude in this calculation. Okay? We discount it using the cost of equity, which is usually based on the capital asset pricing model, which you learned in 280.2. Okay? And if you look at the terminal value, forecasting the terminal value, same formula. Kung ano yung last year, okay, ng FCFE, you grow it by 1 year times 1 plus G divided by KE minus G. And that is the terminal value. Okay? We'll explain more in our numerical example later. No? The good thing about discounted cash flows, it recognizes the potential of every asset and it requires forecasting methods. Okay? You are forced to study, the asset and its underlying business. No? Because you have to make judgments. No? Kailangan mong i-assess ang growth, i-assess ang risks. No? And therefore, it forces you to study the business in more detail. No? It's theoretically sound, since the value of an asset is really the present value of the benefits that you're expected to receive. Okay. However, the problem is there could be too many assumptions. And if there are too many assumptions, it could be faulty altogether, right? Because garbage in, garbage out. Okay. So if the assumptions are faulty, then the valuation is faulty. And since there are so many assumptions to do, in discounted cash flows, you're also at risk, you know, of the estimate to be faulty in the first place. Another valuation method are the relative valuation models. It's based on the law of one price, which says that similar assets should sell at similar prices. Okay. So so if I have one stock of ABS-CBN, under law of one price, it should also be equal to another person's ABS-CBN stock. The price of my ABS-CBN stock should be equal to another person's ABS-CBN stock, right? Because it's the same asset. Okay? So we usually use trading multiples. Two types of multiples. No? First is the trading multiples approach. Second is the transaction multiples approach. Under trading multiples, it's relevant for traded companies or companies that are public or in the stock exchange. Kasi you can get the price to earnings ratio, price per share divided by earnings per share. Then you have a ratio of how much ba ang presyo ng stock per peso of earnings. Okay? Price to book value of equity, price to cash flow, or price to sales multiple. Okay? Now, how does relative valuation work? Okay? Basically, the first step is for you to get comparable companies. Okay? Ano-anong company yung similar, okay, sa company that I'm trying to value. Okay? So for example, I have a company which is a grocery. I'm trying to buy High Top, for example. So it's a grocery with several retail stores, right? And it does not have any, it's not traded in the stock exchange. So wala akong presyong reference, right? So how do I now then do this? No? Under relative valuation model, the first step is for you to identify traded companies that's similar to High Top. No? So anong traded companies ang similar sa High Top? Eh, Pure Gold, no, which is a similar grocery, no. Another one is Robinson's Retail, no. Yun yung mga supermarkets ng Robinsons that could be similar. Okay? So, how do you do this? You want to get your comparable companies price to earnings multiple, for example. For example, the price to earnings multiple nila is 12 times. Okay? So the price is 12 pesos for every peso of earnings. Okay? And then you apply that comparable multiple to the price, to the earnings of high top. Okay? And from there, you're able to get what? You're able to get the total value of of high top. Okay, by using the price multiples of another company that's traded in the stock exchange. Okay, so tandaan nyo lang muna yung concept. We'll do that in the example. Okay, precedent transactions approach naman or transaction multiples, no, means you are looking for previous similar M&A deals. Okay? At tinitingnan mo, yung presyo ba ng M&A deal na yun, gaano siya kalaki versus book value. And that relationship is your transaction multiple. You can use that as reference. No? So for example, similar grocery deals, okay, ang transaction multiple niya is 1.2 times book value. Then I can go to high top and say, ito ang SNR, binili niya yung, ito ang pure gold, binili niya yung SNR at 1.2 times book value lang eh. So, yung presyo ko sa iyo, 1.2 times lang din. Okay? So, that's something na could be also considered as a reference of value. So, a very important step is you want to choose comparable companies. Okay? So, dapat it's very difficult to have or to find companies na comparables na very similar to the company that you want to value. They won't be exactly the same. Okay, but you want them to be the same or to have the same attributes as much as possible. Okay, what are those attributes? Of course, similar sizes, similar business scope, more or less similar leverage, no, and more or less similar profitability. Okay. So you want to look after the market capitalization. You want to remove companies that are too small or too large. You know, business scope. You want to filter out companies with entirely different business scopes. No? Leverage. Gusto mo rin tanggalin yung extremes, no, na hindi similar to your company. Profitability also, you want to compute the profit margin, the return on asset, return on equity, and try to get something that's a little bit similar. Okay. Admittedly, they won't be similar, because precisely because they're different companies. But you just want to eliminate obvious companies that are not part of the mix. So for example, kung negative ang profitability, tanggalin mo na yan. Hindi yan comparable. Right? Kung ang leverage masyado mataas, 90% debt, tanggalin mo na yan kasi hindi comparable. Okay? So we just want to eliminate extremes. Okay? There. And therefore, what do you do in in valuation for M&As? We triangulate. Deciding on the appropriate price is not based on one valuation method alone. Kasi sabi nga natin, price is not equal to intrinsic value. There are multiple intrinsic values. Okay? And therefore, choosing the price is actually an art. Okay? It's not a science. Intrinsic value, that is science, but choosing the price is an art. Okay? There's no single way of choosing the acquisition price. Okay? So let's look at this example. So if you look at TCF, for example, for this company, the value is 250 billion. The book value of equity is 100 million. If you compare it versus relative valuation, it's 180 million. Relative valuation using precedent transactions, 190 million. So how do you make sense of these numbers? Okay? DCF is 250 million. It means, ang ibig sabihin kasi ng DCF, nung inassess mo yung potential ng company, ang value niya with everything, with your synergies, with your assessments, with your growth prospects, ang value sa'yo ng company, 250 million. Okay? The DCF will likely be the ceiling of the triangulation. Kasi anything above that, hindi mo na siya ma-justify kasi the business will not generate that value. Okay? Kasi ang assumption mo sa DCF kasi, that 250 million comes from your study of the growth prospects of the company. And finorcast mo yung cash flows niya, present value mo yung cash flows na yon, and 250 billion is what you got. So, the usual thinking for DCF is the ceiling in terms of the price that you want to pay for an acquisition. Okay, why is that the case? Because wala ka na makukuhang cash more than 250 million according to your analysis. Okay? Book value on the other hand, okay, will usually be the minimum price that the seller will be willing to sell. Okay? Kasi the book value represents the amount that he invested into the business. And if it's a good business, he will definitely want to at least get it back. Okay? That's how you will interpret book value. So looks like the range that we are looking at is 100 million to 250 million as the acquisition price. Okay? What's the role naman of the relative valuation? Okay? Yung relative valuation usually shows market potential, okay, or the market's view of pricing. Then pwede mong sabihin, if you look at the market, ang value nito sa market, 180 million. Ang value ng, and if you look at precedent transactions, ang value niya 190 million. So 200 million might be a good price for you. No? Pwedeng ganun ang takbo ng negotiations or takbo ng discussion mo. Okay? 200 million lang ang willing akong ibayad dyan. O binibigyan kita ng 20 million premium over relative valuation, 10 million premium over a precedent transaction, which may be a bigger company, right? So it's good enough. But definitely, sa baraha mo, you won't go higher than 250. And you know that you should not be offering anything lower than 100. Kasi baka ma-insulto yung buyer, ay yung seller, right? So that's how you triangulate, no? Um, bakit 200 yung napili ko? Eh, yun yung mukhang tama or mukhang acceptable under this scenario, right? Kasi ang relative valuation, 180. So alam ko lang na hindi ako magpe-presyo more than 250, hindi ako magpe-presyo less than 100. Yung relative valuation is a good indicator of what's the market's perception. No? And you can always reference the market's perception in terms of pricing stocks or pricing acquisitions. It's always a good reference. So, yung market nga, 180 million ng valuation sa'yo. So, binibigyan kita ng additional 20. So, 200 million. So, at 200 million, there is a 50 million added value to you as the buyer. Kasi you are receiving value worth 250, you're paying value of 200. So that's what I meant when I say that acquisition price determination is actually an art. No? You have to give yourself some negotiation space also. You don't want to go in and say 250 million. No? Kasi mag-negotiate pa kayo ng presyo eh. I'm sure pataas yun. Right? And kung 250 yung una mong binaba na presyo, eh, wala ka nang choice. Pag umakyat niya ng 250 sa negotiation, back out ka na agad because you cannot justify 250 or higher than 250 because your DCF is also only 250. So that's what I meant when I say determination of the acquisition price is actually an art. Okay? Sige. Now let us go. Let's go to the example that I made. No? So let's assume that you are buying ABCDE company's shares. No, you want to buy this company and you want to buy 100% of its common shares. Okay? And by buying 100% of its common shares, you now own 100% of the company. Okay? You want to do a valuation exercise. Okay? So let's look at this example. So in December 31, 2019, this is the information that you have. No? You have sales, cost of goods sold, OPEX, interest, depreciation is 1 million, which is included in OPEX, and the income tax is 30% of EBT, earnings before taxes. You're given the balance sheet of the company, no? The stockholders' equity, the book value is 15 million pesos with 1 million shares outstanding. So therefore, the book value per share is 15 pesos per share. And you have the capital expenditures, increase in current assets, increase in current liabilities, principal payments, which is payable for the next 5 years, no? And new debt obtained, which is 40%, okay, of capex for the certain year. Okay. The first step in valuation is for you to assess the company and to forecast its cash flows. No? So based on your assessment, for example, no, sales are expected to increase at 10% per year for the next 5 years. Okay. And cost of goods sold are expected to grow with sales at the same rate. So siguro based on your market assessment, nakita mo na oh, the sales will grow 10% per year. Now, with increases in operations, there will be more cost synergies, and therefore cash OPEX are expected to grow at a slower pace, 8%. No? Working capital expected to grow at 8% as well. All right? So, yun ang naging forecast mo. Capital expenditures are expected to increase 3% for the next 5 years. And depreciation, new debt obtained, and principal payments and interest expense are expected to grow at the same pace of 3%. So, yan yung assessment mo of the business. And therefore, the next step is for you to forecast net income, FCFF, and FCFE from 2019 to 2040. So, let's do this. No? So, let's look at 2019 first. So, buuin muna natin yung FS ng 2019 or income statement ng 2019. Sales is 10.5 billion. Cost of goods sold is 5 billion. Sorry, it should be negative. And cash operating expenses is how much? Cash operating expenses is 3 million, pero ang sabi, it includes depreciation, which is non-cash. Kaya 2 million lang yan. How much is depreciation? 1 million. Okay. Interest expense, 500,000. And tax expense daw is 30% of earnings before tax. Okay? So that's the net income for 2019, which is not the forecast period. 2020 ang start ng forecast period. Now, let's now form the forecast. So sales will grow at 10%. Okay. Cost of goods sold will also grow at the same rate. Cash OPEX will grow, sabi, at 8%. Depreciation will grow at 3%. Interest expense will grow at 3% according to the problem. And tax expense will be 30%. So from here, we can now forecast it for the next 5 years. Okay? So here now is the review nga natin. Sales, okay, cost of goods sold, cash OPEX, okay, depreciation 3%, interest should be 3%. This is okay. So that's the forecasted net income over the next 5 years. Okay. Next, we want to compute the free cash flow to firm. How do you compute it? Let's pick up net income. Okay. Add back depreciation. Oops. Oops. Ano ba yan? Okay. Increase in current assets. How much is the increase in current assets for 2019? 300,000. An increase in current assets is a reduction in cash flows. Okay. An increase in the increase in current liabilities is this. And an increase in current liabilities is an addition to cash flows, remember? Okay. And then we add back. And then ito raw will grow at 8%. Sabi sa assessment mo. And this will also grow at 8%. Interest post-tax will be added back. Okay, how much is interest? 500,000. No? How do you make it post-tax? Multiply it by 1 minus the tax rate, 30%. Okay, you add it back. And then you deduct capex, which will grow at a rate of 3%. Okay, so with that, you're able to compute that the free cash flow to firm is this much for every year. Okay ba? Let's now compute the free cash flows to equity. Actually, maraming similar items, so we can just reference it there. Net income, add back depreciation, increase in current assets, increase in current liabilities, capex. Okay. And then you have new loans. How much is the new loans in 2019? 40% of the capex. So times capex. Okay. So that's how much new loans are. Loan payments, on the other hand, 200,000, pero negative yan. And it grows with capex according to your analysis. So there. So you're now able to get the forecast. That's the first step of discounted cash flow analysis. Okay. So we're now able to compute the free cash flows to firm, which is this. And the free cash flows to equity, which is this. So if you see, they're different. No? Their difference is the cash flows related to debt, or to creditors. Okay, let's now go to the next slide wherein we compute and we do the valuation. Okay, so the cost of its long-term debt is 10% before tax. The treasury bond rate is 6% and expected market return is 12%. Okay. Okay. The company has an equity beta of 1.2, and the company is expected to grow with the long-term economic growth forecast of 3% after the fifth year. In other words, this is the terminal growth rate. Okay, so let's compute for the cost of debt and cost of equity. So the cost of debt, according to here, is 10% gross of tax. The tax rate is 30%. So we need to get the post-tax rate. How do we get that? That's 10 times 1 minus tax. So the post-tax cost of debt is 7%. For the cost of equity, we do the capital asset pricing model. How do we do that? Start with the risk-free rate plus beta times market return minus risk-free rate. And therefore, the cost of equity is 13.2%. Okay. So the cost of debt pre-tax, post-tax rather, is 7. The cost of equity um, is 13.2%. How do we get the WACC? Okay. We get the proportion of debt in equity. So the proportion of debt is 5 over 20. Oops, 25%. And the proportion of equity is 15 over 20, 75%. So to get the WACC, we simply use the proportions, and our WACC is 11.65%. Okay. Now let's compute the terminal value. Okay. So the terminal growth in the problem is 3%. We need to get the last year of the FCFF. In this case, it's equivalent to this year, right? 2024, which is the end of the fifth year. Okay. So that's the FCFF at year 5. You need to grow it by one more year. No? So this times 1 plus 3%. Okay. And this one is you get the perpetuity value, which is equal to, since this is FCFF, the denominator should be WACC minus the growth rate. So this is the terminal value. Okay. Sa equity naman, you get the FCFF at year 5. Sorry, FCFE at year 5, which is 2.4. Okay. You grow it by 1 year. 1 plus G. Then this divided by cost of equity minus the growth rate. So that's the terminal value. How do you now assemble the equity valuation, the enterprise and equity valuation? Okay. So ilalatag mo siya na, so you get the FCFF for every year, 2020 lang. Kasi in 2019, historical yun. Okay. So ilalatag mo in 2020 up to 2024, and then at 2024, you include the terminal value, sum E, present value. And then this is the amount that you will get the present value. So how do you get the enterprise value? Get the present value at the WACC, okay, of all of these values. So the enterprise value is 22 million pesos. Okay. If you want to get, since we are not buying the assets of the company, we're buying the equity of the company, right? So we need to transform this into the equity value per share. Okay, how do we do that? Remember, enterprise value is equal to the value of debt plus value of equity. So you can get value of equity by reducing or by deducting the value of debt. So the value of debt is 5 million. So therefore, the value of equity is 12 minus 5. Okay. And to get this per share, remember there are 1 million shares outstanding. So the equity per share, price per share is 17.56. Okay. So that's called the FCFF approach or the enterprise valuation approach. If you look at equity valuation approach, ganun din, ilalatag mo siya per year. No? To get the equity value, you get the net present value at what rate? At the cost of equity. Okay? And you get this. And then to get per share, you multiply it by the shares outstanding, 18.45. Okay? So that's how you got the intrinsic value of this company, no, of this company's equity, no, using enterprise valuation and equity valuation. Okay. So the total equity value is 18 million, which means that's a total acquisition price of 100% of the company. Okay. But on a per share basis, that's 18.45. Now let's try to apply relative valuation. So determine the relative valuation of the stock using the following. First, The industry trading PE ratio is 12.2 times, sabi. Okay. And letter B, based on precedent comparables, the transaction multiple is 1.3 times of the book value of equity. Okay. And then let's compare valuation and form your conclusions or pricing strategy. Okay. So how do you apply relative valuation? No? Ang, ang current price per share ng company is 15. Sinabi in the problem kanina. Right? Ang earnings per share ng company is something that we can compute based on 2019, right? Total earnings in 2019 is 1.4 million, right? Divided by number of shares outstanding, which is 1 million. Okay? And therefore, the current earnings per share, the PE ratio of the company is 10.71 currently. No? However, comparable companies daw, ang kanyang PE ratio is 12.2 times. So under the law of one price, okay, the PE ratio of this company, of ABCDE company, if it's comparable to the industry, is 12.2 times. So you can actually forecast the price by getting the earnings per share that's forecasted for 2020. Okay? How much is the forecasted 2020 EPS? You get the net income in 2020, 1.641, divided by the number of shares. So the earnings per share is 1.64. The industry benchmark PE ratio is 12.2 times, and therefore, we can forecast that the price is 20, should be 20 pesos. Okay? Kasi remember, PE ratio is price per peso of earnings. Okay? And here, ang sinasabi is 1.64 yung earnings. So therefore, 1.64 times 12.2, 20 yung kanyang magiging forecasted price. Okay? If you use comparable transactions, okay, we need to get the forecasted 2020 book value of equity. Okay? How do we do that? Okay? Alam natin na nung 2019, stockholders' equity is 15 million. Right? That's the book value of equity. And then nung 2020, nagkaroon ka ng net income na 1.1. Okay? So that's the total book value of equity. Okay? Itang sabi, the transaction multiple is 1.3 times. So this is the total transaction price. And to get it per share, you divided by 1 million. Okay? So if you look at the valuation range, the current market price is 15. Okay? If you use discounted cash flow, the value that you are getting is 17.5 to 18.45 per share. But if you look at the market's valuation is high, 20 and 21. Okay? So what insights can we get here? No? For the current market price, this will likely be the minimum price of the seller, right? Because if he sells it into the market, mabibenta niya at 15. Okay. Your DCF valuation is 1845. This will likely be the maximum price, no, of the buyer, right? But your problem is the market perception of value is higher than your intrinsic value. And therefore, there could be some problems in negotiation here, right? Kasi the current market price is 15, but if you look at market perception of comparable companies, it could go as high as 21. And 21 is too high with respect to your DCF calculations. And that could pose a potential problem for you. Okay? So, how do we then do this? In terms of negotiations? First, the first thing, if I were in this situation, the first thing that I'll do is I'll review the synergies. I'll review the growth prospects. Am I missing something? Okay. Kasi definitely the market is seeing something in terms of the industry. Kasi this company should be worth 20 pesos if it's performing at par with the industry. Okay. But I'm not reaching that valuation. So the first thing that I'll do is review the valuation. Am I seeing everything, all the value that I need to see? Now, if you're convinced that you have seen all the value that you can see, that you have incorporated all the synergies that you can incorporate, and this is really the price, then your negotiation stance with the seller, if you are the buyer, your negotiation stance is to highlight on what are the negative aspects, right? We want to price at 20 or at comparables, but we're seeing that you are growing less than the industry actually, and you don't have the potential to grow with the industry, or there are too much risks in terms of your operations. So, kumbaga, the posture in terms of negotiations is also dictated by the valuation range because you know how the other party is going to think about valuation. No? But of course, we don't know the intrinsic valuation of the counterparty. Pwede ang intrinsic valuation niya 12. Okay, kasi mas marami siyang alam na negative about the business. Okay? So, pwedeng may deal pa rin, no, kahit na ganito yung scenario. Pero the point is, the valuation range gives you an idea of how the other party will be looking at, at this transaction. So here, may bala siya. Ang bala niya is that if you look at industry comparables, he is priced at 20 pesos. His shares are priced at 20 pesos. So he has to prove that his growth prospects will be at par with the industry. Okay? That he is not a laggard in the industry. However, you're seeing that he's a laggard in the industry. And therefore, that will be the discussion point. You know? It might be the case that you can settle at something below 15 and 18, no? Between 15 and 18. No? Depende kung gaano ka desperate seller or baka naman siya, ang intrinsic valuation niya is less than 15 naman talaga. No? Pero posturing niya, syempre, start siya sa 20. Comparables 20 eh. Then ikaw, you start discussing why is their company not at par with the comparables in the industry? Okay, and that's how you start negotiating downwards. Okay, so I hope I was able to give you a flavor of how a deal flows, no, in terms of valuation. And with this lesson, we're able to get an overview of company valuation. There's a lot more details, but we simply don't have the time to discuss all the details with respect to valuation, but hopefully this session gave you an idea of how valuation is done on an M&A setting. Okay, thank you, and see you next time.